Dan Lacalle has spoken about this a few times as well, CIO, Gestion, SGIIC. Daniel, very good morning to you. So how tricky is the situation for European policymakers? And in a recession, is it inevitable?
I think that recession is inevitable. Good morning, absolutely, because you have just mentioned two key points: the wrong energy policy and the wrong monetary and fiscal policy. We have seen the ECB drag its feet for too long, and it's coming too late to take action on inflation. At the same time, you have most of the peripheral governments and the European Union in general unable to contain the deficit spending in an environment in which there is also, for the first time in years, a trade deficit which weakens the euro. And on top of that, an energy policy that has made Europe more dependent on Russian gas, and certainly with an intermittent and volatile energy mix that makes it extremely dependent on fossil fuel energies in the worst periods when there's more demand and they're more expensive, and that generates incredible tensions between different economies. Think about this. France is now rejecting a gas pipeline from Spain to Germany, and there's all sorts of different strategies between the different countries involved that are crippling the European economy. Gas prices through the roof, electricity prices through the roof, higher inflation, not just because of the general environment that we're all living, but because of an extremely imprudent monetary policy and a very weak euro. It's almost a perfect storm.
Oh, yeah, I thought you might say that. Is there any good... I don't mean to be glib about what you've just said, but you and I and Karen and Jeff, we discussed this for a long, long time. Is there any good news, actually? Is there something that actually we need to say, yeah, we can hang our hat on this, though?
Yeah, I would say that there's a couple of positive news to cheer up the proceedings. The first one is obviously that despite the fact that the European Union has been suffering the largest impact of the Ukraine invasion in the last months, PMIs, for example, are not that bad. They're in contraction, but they could have been significantly worse. The other, obviously, is GDP. Gross domestic product is not doing so bad as compared to previous occasions. However, most of it comes from very elevated government spending, which means much higher consumption of newly created currency. But it is true that on the other, if I have to look for another positive sign, the levels of storage of natural gas in the European Union are at least promising, because levels of gas storage are around 77 to 80% in the major economies, and that could make at least the prospect of severe disruptions of supply much less possible. So that's not, those are the three positives I can think of.
Daniel, can I bring up the fiscal interventions in Europe? It's been a thorny issue for many years, and as we talk about crisis here, from inflation, from energy, what sort of fiscal interventions are going to be allowed over the course of the next couple of months and years?
I think it's going to be very difficult, Karen, because the challenge for the European Union now is, what do we do next? The policy of massively increasing government spending, lowering rates, and increasing money supply has been exhausted. That is the biggest problem. We see, for example, the different energy plans and energy conservation plans that the European Union has put together. It doesn't even scratch the surface of 150 BCM consumed per year from Russia. So the challenge for the European Union is that it's not going to be easy to confront a very challenging winter with the same policies that have not worked particularly well. Think about this. When the pandemic started, estimates all over the world from international bodies were assuming that the European Union, because of the massive fiscal response, was going to get out of the crisis stronger and quicker than the United States. It ended up being the opposite, as we discuss actually in this program. And one of the elements that we find now is that there is very little else to do. The Spanish economy, the Italian economy are going to have a 5% deficit. What would a 6.5% deficit do? Nothing.
Daniel, if we piece this together then in terms of the market reaction, we already know that hedge funds are betting against Italy. Should we be concerned about strain across the eurozone, even though we've got this anti-fragmentation tool from the ECB?
Well, I think so, because the anti-fragmentation tool limits the risk. It certainly doesn't eliminate the risk. It doesn't do anything to the underlying solvency and liquidity risk of the economies, but it might mitigate the movement and spreads for a few months. But it's not going to do it forever. It's simply a message, or simply a message from the European Central Bank saying that we are looking to do whatever we can to try to keep this very complicated puzzle of different fiscal policies together, coupled with the requirements of each of the government's fiscal needs. However, the problem that I see is that, on the other hand, the ECB is not counting with a strong euro, and that is critical because what we need to look at fund flows. So it's very difficult to believe that even with the anti-fragmentation tools, that there's not going to be outflows from European sovereign debt, particularly when the fiscal situation is worsening. And it's not easy. I mean, it's not for the ECB, to be fairly honest, to solve it, because the ECB can do as much as what they've already announced, but it is for governments to understand that imprudent fiscal policies are not going to help in a situation like this. And it reminds me, although it's very, very different, but it reminds me of the lack of attention to reality that governments had in 2011, 2012.
Daniel, what we're talking about market bets as well, away from the bond vigilantes, what we're seeing is short bets too on the stock market, in particular around technology names. I noticed that you've got a call to reduce exposure to tech into October. These are stocks, in some cases, Meta, for instance, down 50+%, so far, Apple down a little bit less, down 8% over the course of this year. How much further can these stocks fall if we're looking at short bets on them?
It's very difficult to understand how far down can they go, because it's also very difficult to know how far up they can go considering the valuations. We are testing what are the real valuations that these stocks should have, but at least what we know is that it's very difficult for technology stocks to go up in the market in an environment in which monetary policy is restrictive. I think that is already a consensus view, and everybody can see it. When money supply growth comes down, technology stocks come down as well, and the opposite. So what I believe is that you need to be extremely prudent about technology in general and look only at companies that have strong cash flow, discernible earnings, and a strong market share, and avoid everything that is sort of concept because until October, at least, when we have a better view about whether the Fed is actually going to move its needle in terms of the rate hike path, etc., I don't think we're going to be looking at a sector that is going to drive gains like it did in the period of monetary expansion.
Dan, always great to catch up with you. Thank you so much for joining us again today. Daniel Lacalle with us, the CEO at Tressis Gestion.